Hello, everyone. Welcome to Winning in 2021 webinar series. My name is Mike Dale. I'm happy to be with you today. We've been conducting these webinar series for the last month or so, covering topics around business health and performance, looking at culture values in our attempt to provide some education, training, and information to our partners and to our clients. I am a director of strategic partnership and business development with iSeek Solutions. And today we want to talk about key performance indicators for a healthy organization. And if you're not familiar with iSeek Solutions, we are a group of expert consultants focused on creating value for organizations by designing and implementing solutions that really take a hard look at your strategic goals and objectives. And one of our keys is that we focus on wherever in your business where there is misalignment to achieve alignment around your technology, your people, in your processes. That's at the heart of every client relationship that we have at iSeek Solutions. So let's talk about key performance indicators for a healthy organization. And we'll look at a couple of things today. We're going to look at how to define your organization's KPIs. We'll take a look at examples of a healthy organization's KPIs. We'll take a look at assessing your organization's health. And then lastly, we're going to take a look at iSeek's approach to diagnosing your organization's purpose, objectives, and goals. And we do that through a resource that we've created called the Business Health Check. So we'll take a look at that. We'll look at how we've done that with a partner client of ours and go into a little bit of a look on a case study. So without further ado, let's go ahead and get into the webinar. And I don't know if anyone has read the book by Simon Sinek that talks about you always start with why. You always answer the question of why when you're looking at your future goals, when you're looking at where you need to develop yourself, and even for businesses, when we are developing our strategic plan, our strategy for the future. We always want to start with that question, why are we doing this? And one of the things we see here is that it may be a simple reason that you want to be successful in your organization. And in order to be successful, you have to be able to track, identify, and monitor what success is. So the goal of this whole KPI discussion, even within your organization, is going to be to measure the health of your organization and be able to track those not only 50,000 foot indicators that may occur on the corporate company level, but also those indicators that may be on the departmental level. So there's some guidance that we like to look at when we talk about KPIs, key performance indicators. And let me sort of clarify first or define what a KPI is, a key performance indicator. It is a quantifiable measure used to evaluate the success of an organization. And the reason why we prefer that a KPI and the industry prefers that a KPI is quantifiable is because it's just easier to measure, compare, and contrast a numeric value instead of using a non-numeric value. Makes sense. So whenever we talk about measuring indicators that track and identify whether you're progressing or performing in the right way down the road of your company or your organization, we want those values to be numeric, want them to be quantifiable, want them to be metrics. So we talked about success. We talked about success, and when we look at success, that's really one of the keys. Success is one of the keys that you need to look at. What is success for your organization? A few weeks ago, if you look at what we talked about in our first session, we looked at strategic planning and development and how it's extremely important for your organization to have a strategic plan. And along with the strategic plan comes your mission, comes your vision, and it also, you should be setting up goals and objectives that are measurable. So your success, right, should be tied to the goals and objectives of your organization. So in turn, your KPIs, those indicators, they should be aligned with what success looks like for your organization. For example, one of your strategic goals for your organization may be to increase sales by 10% over the next year. And so that may be what success looks like for you, to increase sales within your organization. So if that's a success area for you and your organization to increase sales, the next thing you want to do in sort of scoping a KPI, you want to look at what activities support success. So what and where in operations, what and where in product, what and where in the different areas of your business and services, wherever the business lines are for your organization, what activities within those areas will support that 10% increase in the sale of products. And so now we start to see how we're sort of supporting the success area that we want to monitor, that we want to track, and that we want to indicate or identify what the indicators need to be for success. So we have the activities. We know that, for instance, operations needs to produce more widgets in order for us to sell a higher number of widgets and increase sales by 10%. So those are the activities. We need to up production by a certain proportion or percentage. Now we have to attain what measurements and how we need to align measurements to those activities. And so if we use the example of needing to generate and produce more widgets so that we can meet the 10% goal of selling more widgets, now we're looking at the KPIs. We're looking at the indicators that say that we're performing well. So for example, in production, if we're needing to produce more widgets, then we may have a volume or a quantity KPI or measurement that says each week or each month or each quarter, we need to hit this number of widgets being produced so that we can support the overall goal of increasing our sales by 10%, so that we hit that success area goal of our strategy. Hope that makes sense. But those are three sort of scope guidance areas. You look at success, you look at what success means to you, you look at what activities support success, and then you start looking at, okay, how are we going to measure those activities that support success, and then we can start tracking those measurements, activities that align with success. All right, well, let's look at just three simple keys to defining your KPIs. Real simple, only three. If you look on the internet, you'll probably find 10, 20. There's lots of keys. There's lots of best practices, standards around producing KPIs, creating them, how to categorize them. But what we want to do is really articulate some simplicity here, because we only have 30 minutes to talk. And so the first thing that we want to look at is just creating something useful, right? What we don't want is something that won't be actionable, won't be something that's insightful. If you look at this graph on the left side of the screen, you see that the chart shows that the most useful KPIs provide a high amount of insight and are actionable in the short term. Now, in contrast, it's better to avoid KPIs that are low on insight and take longer to correct the adjustments and the corrections that need to be made. So that makes plenty of sense, right? We don't want KPIs, we don't want performance indicators that measure the wrong things, that don't provide information to those who need to make decisions in order to make corrections, to make adjustments. So in the example where our strategic goal was to increase sales by 10%, we would hate to have a KPI in place that supported something different or other than the sales increase of 10%, because at the end of the day, those KPIs would be useless. And so we want to make sure that we have the right measurements. Those measurements are metrics against the right set of activities that support that ultimate success goal that you have. Number two, very simple, classify your measurement or your metric, right? And so we want to really just look at here 5 types of metrics. And that's how we sort of classify your metrics, because there's, again, if you Google metrics or measurements or performance indicators or KPIs, you're going to see hundreds of different types of ways to classify, to categorize a KPI. But the goal here is to go ahead and set up what questions that you're trying to answer. And you see here that we give you 5 really good examples of types of metrics that are usable. Number one, if you look at the question of how well are we doing? How well are we doing? That's a sort of a classic metric or classic question that a company will ask. And the type of metric that we have here is one that looks at the outcome and looks at business drivers. And we know that, you know, if you're selling a product, a service, or a solution, you definitely need, for example, leads. If you have a portal, you may need visitors to your portal. So how well are we doing? That's the question that you're trying to answer. So in this metric, the KPI may be the number of leads that are coming into our sales process or coming into your website portal. And you may measure that. You may measure it in terms of volume. You may measure it in terms of quantity, in terms of unique visitors. These are all ways to indicate whether you are performing well or not. What about number two? Number two asks the question, how can we do better? And the type of metric that answers or addresses that question is a diagnostic metric. And if you look at, for example, customers who are not customers yet, but actually prospects, and we talk about the example of a conversion rate. So conversion rate means that you have prospects who may be leads, who may be visitors to your portal. A conversion rate is whether those prospects are actually turning into paying customers. So the type of metric that looks at that is diagnostic. Just simply, what is the conversion rate? Are we turning prospects into customers? And are we doing that at a good rate? Is it 1 to 2? Is it 1 to 5? Is it 2 to 8? That's a key performance indicator to allow you to see if you can do better. The next one, number 3, is a smoke alarm metric. This is more of a warning. This is more of a red flag metric or KPI. The question here is, what are we doing poorly? What are we not doing well? And so the example you see here, zero yield searches, that's really an example of when you, for example, have a product that you are selling or marketing, and you have someone who has identified or searched or found your product, but for some reason they're not purchasing the product or the service or the solution. They're not converting. They're still prospects. They never actually convert. So that's what we call a zero yield search. So something's not right there. That means that you have the right product, but for some reason, the purchase is not occurring. The requisition of the service or the attainment of your solution is not happening. So that's a red flag. And so the type of metric is called a smoke alarm metric. And that's an easy one to put in place so that it can indicate whether you're doing something incorrectly. The last two are number 4 and number 5 are the predictor leading indicator, which sort of happens before the sale. And number 5 is the latent metric, which happens after the sale. So still both very good KPIs, should indicate what you can do better, where there are opportunities. There's always opportunities to do better. And if you have the right KPIs in place to answer these questions, some of these indicators can show you that there's ways to maybe produce or generate or try something different that will enhance the sales of your services, solutions, or your product. If you look at number 5, where a latent type of metric answers the question of where's the opportunity, the examples there is looking at your voice of customer data, which is through surveys, through interviews, through looking at different types of data, competitive data, doing correlation models between your product and other products. So this may be something you do after sale, but it's still an indication of how well you're performing in the market. So this was just 5 types of metrics that we would suggest you take a look at. Very simple to construct. Some are sort of warning metrics, some are diagnostic metrics, but you see where you could probably look at different ways to indicate whether you're performing well or not in your business. Okay, and lastly, at the end of the day, you want to make sure that your KPI is aligning with your strategy. And so if you have defined your success, which we talked about a couple of slides ago, if you've defined your activities, here is where you just need to make sure that it's aligning to a strategic purpose, a strategic business outcome, and that there is the right buy-in across your enterprise and your organization to ensure that you're measuring the right things that make sense for your organization. And we always look at business, we look at technical, we look at process. And one of the things that may be missing in number 5 here is the people. We always want to make sure that we're covering the bases in terms of your strategic goals and objectives, the business outcomes that you're looking for, and looking at all the pieces of your business that may align to what you define as being successful. Okay, so we're halfway through. We wanted to just look at a few examples of KPIs. Now, there's different areas of KPIs. What you probably see most in the market is the market looks at your organization and looks at the financials. How much cash do you have? What does your cash flow look like? And a lot of market participants look at cash flow. They look at your income statement. They look at your balance sheet. All these are KPIs. They measure the solvency of your company. Depending on what KPIs you use, your organization can be deemed solvent. It can be deemed investable. It can be deemed stable. And so you look at assets. The KPI around this area would gauge your organization's ability to liquidate or secure your organization, something that your organization is trying to secure or obtain. You may want to get credit from a lending institution, and lending institutions secure their loans by the use of assets. And generally, generally assets are what we call hard assets. That's real estate, inventory, equipment, machinery, etc. And so the quantity of assets and the value of assets, it's a major indication of how your business is performing. And then lastly, but not less importantly, is what we call earnings before interest, taxes, depreciation, and amortization, EBITDA. And it's just a quick acronym that's well known in the industry when you talk about auditing your financials, understanding what your gross profit looks like before items within your financial are removed, such as for your expenses. This is another performance indicator. It shows what your earnings are. It shows what the generation of cash flow is for the owners of your company, and it judges the company's operational performance. Let's look at another set of examples. Sales KPIs. Now, we talked about earlier, talked about the sales pipeline, conversion rate, sales revenue. But here, a major source of income for most profit organizations is the sale of their products, services, and solutions. Most companies, large or small, they have a sales team. They may have, just maybe even one person who goes out and he or she will market and sell the product. When we talk about the sales pipeline, this is where you have your prospects, and we may be able to here look at a KPI that may indicate whether you have the potential to convert a prospect to an actual customer. So that's your sales pipeline. And anyone who's selling goods, selling products wants a large volume of potential customers in the pipeline. So that's an indication of performance. Then we talk about the conversion rate. Like we said earlier, this is when you're converting customer into, or converting prospects into customer, and you want to measure that rate. You want to make sure it's as close to 1-to-1 as possible. You would hate for it to be lopsided, where you're not converting a lot of potential prospects into full customers. And then, of course, your sales revenue, very important to the life of the customer, to the life of the business, to have a good stream of revenue through your sales pipeline and converting from prospect to customer. All right, another example of KPIs would be service KPIs. After the sale is made, your organization may be providing a particular service to a new customer. So according to the Project Management Institute, the leaders in promoting project management processes around the world, they say that a simple way to assess and monitor your services and what we call projects would be to track scope, track time, and track costs. Project Management Institute refers to this as the triple constraint because an impact to either of these areas, time, budget, or scope, could be impactful. It could impact the other. So it's agreed upon that these indicators should be set up to be expected. So if we're, for example, providing a service to a converted customer, we want to set a deadline of when we'll be able to provide that service or complete that service, and that's a KPI. Not only does that ensure that we have a fixed time to provide that service, but it also provides the customer with an expectancy. Same thing with budget. If we inform a customer that a service is going to cost a certain number, then we want to make sure that we complete on that number. And if we're not completing a service, if we're not providing a service in a certain time frame or on a certain budget, then that's an indicator that something may be wrong. And that leads into customer satisfaction. And customer satisfaction can be measured through surveys, through interviews, through voice of the customer. There's several ways that we can measure customer satisfaction. Okay, another KPI are employee KPIs. We look at employee satisfaction, where we can, again, do interviews with employees. We can also do surveying with customers. We can sort of put those surveys and interviews and the results of those surveys and interviews on a trend scale to see if satisfaction from employees is decreasing or increasing. So there's several ways to indicate whether we're performing well as a company in looking at these employee satisfaction data. Look at attrition rate. It's another KPI, otherwise referred to as a churn rate. It's a common KPI that monitors employee fulfillment. The attrition rate can be an indicator of how happy your employee base is, and that supports the overall culture of your organization. And generally, an organization wants a low attrition rate to ensure the retainment of knowledge, of stable labor costs, and of course, a steady level of customer support. And then lastly, revenue per employee is a common measurement to sort of look at how the organization is performing in terms of its labor costs. So it's generally a measurement that looks at total revenue or gross sales of a company, and we simply divide that by the total number of employees. So it's just a good way, a typical way, a well-accepted way that we can sort of measure our revenue against our cost for employees. Okay, so let's start to wrap up here. If we're looking at assessing our organization's health, here's just a few outputs that we want to make sure that we're sort of focused in on. One assessment output is ensuring that we have an objective view of your current business. Another is identifying the strengths, weaknesses, opportunities, and threats. That's a very popular way to sort of understand if there's any gaps or misalignments in your business that need to be strengthened, that need to be adjusted or corrected. And then lastly, one of the outputs of a good assessment on the health of your organization is to come up with some actionable plans that help to fill these gaps, to align the parts of your business that may be misaligned, align those to, again, your strategic goals and objectives. So here's a resource created by iSeek Solutions. It's the approach that we use. It is a customized business health check, the IBHC. It consists of two simple phases. Number one, iSeek will look at the business purpose, look at your objectives, look at your goals, do a SWOT analysis, understand where the gaps and misalignment is. And then number two, in the second phase, we'll assess your business model to determine what's working, what's not working. And there is where we'll take a look at the KPIs you have and the KPIs that you don't have. Because again, as we've gone through here, we know that it's important to have indicators that allow us to see, allow your organization to see whether you're performing well or not. And through this customized approach that we use, the IBHC, we're able to come up with a broad solution of comprehensive planning around a potential roadmap that will ensure that you have an overall healthier business going into your future. So we'll wrap up here with a case study of one of the partners that iSeek Solutions worked with. This was the city of Birmingham in 2018 when Mayor Woodfin and his administration first came into the city of Birmingham, and the mayor announced that within the first 100 days, he wanted to perform a performance assessment. iSeek was engaged to provide oversight and advocacy and project management with the other vendors who were engaged in this process. iSeek provided this unique oversight, project management. One of the reasons why iSeek was chosen was because iSeek is very well familiar with local government, familiar with providing coordination and leadership, and iSeek worked with the vendors to provide assessment recommendations that concluded with 33 suggestions that targeted cost savings, revenue opportunities, and operational efficiencies. And again, here, KPIs were at the heart in assessing where the city was, what they were doing well, and what needed improvement. So each recommendation was descriptive, contained the appropriate detail analysis, which explained what alignment was needed in order to drive the city in the right direction and to focus in on priorities that was underscored by the mayor and his team. So just an example of a successful engagement where the city's operations and financials were assessed and looking at performance indicators where suggestions and recommendations were made against activities conducted by the city in order to ensure that they could meet their goals in order to be successful. So with that, we'll wrap up. Thank you so much for joining this episode and session of Winning in 2021 webinar series. And we look forward to seeing you at the next webinar. Thank you so much.